Bhatia joins us, head of fixed income group with DSP Investment Managers. Saurabh, what do you think has been the impact of for the debt category in last 2 weeks, given that we've seen a sharp rally, at least in benchmark papers, both in the long term and short term? There has been a sharp rally. When I say long term, short end and long end.
Sure. Hello and good morning. Well, the large part of this rally has come in more from the risk premia, which started to fade away post the exit polls which came in. This definitely gives a lot of comfort that going ahead from a rates perspective, a slowdown in growth, a benign inflation, as well as a very strong mandate should cap the extent of populism which market was fearing if it was a tight mandate. Secondly, whatever is happening through the global economy over last fortnight or so is giving further comfort for RBI to ease both liquidity and the rate stance as such. So this gives a little bit added comfort for yields to head further lower as we head into the policy. Over the last 2 weeks, the move of around 40-45 basis points in the benchmark 10-year has been largely this risk premia which started fading away. On the shorter end, definitely the last two policy rate cuts didn't see much of the impact coming onto yields, because still markets were looking for the visibility on liquidity, and hence with a considerably sharp slowdown in growth, the numbers what we saw on Friday, as well as benign crude prices, benign global growth outlook, the expectations of not only a rate cut but a shift in stance comes into the policy, and hence we are seeing the entire yield curve shift lower.
Saurabh, do you think that irrespective of what the RBI does in this week's policy, and all expectations are headed towards a 50 bips rate cut, given the kind of macro parameters and factors that you just talked about, they still have further elbow room to ease in the latter part of the year as well, in the next 3 or 6 months, in the short term, that is?
Going into the policy, we are expecting more from a shift in stance. We have already had a 50 basis point rate cut in February and April. The yields haven't responded to that, largely because of the outlook on liquidity or visibility on liquidity, and hence I won't be surprised if RBI does a lesser multiple of 25 basis point also in this particular policy, but more importantly shift the stance from neutral to accommodative. This will allow the much needed monetary transmission what we are looking at, because repo and market yields have different bands which move them, different trigger points which move them. Repo is largely moving on inflation and growth outlook. Market yields are largely moving on demand supply. So for repo rates to correspond, the repo rate moves to correspond to market yields, what you need is a little bit more visibility on liquidity, and this liquidity to be on a surplus side. So like you rightly pointed out, maybe a 25-50 basis points and elbow room gets reduced, and hence I think RBI would press a little bit more on liquidity transmission, on the transmission of rates, which should happen ideally through the liquidity measures as such. A change in stance from neutral to accommodative would be a big help in that.
Saurabh, do you believe that going forward, in terms of the overall outlook, that is going to remain fairly constructive, and in terms of what we're looking at in the budget as well, that fiscal continuity will be the order of the day?
Well, for interest rates to head lower, you need a slower growth cycle, you need benign interest rates, and largely these things are in place. From the budget standpoint, the fiscal room is definitely lesser. The fear what market had going into election was, if it is a tightish mandate, then we can have a relatively loose fiscal as well as a monetary policy, which can effectively have a negative impact on the immunity of the economy. With a very strong mandate, I think government going into budget will try to balance the fiscal as well as the growth push. And getting skewed on either of these things can have a little bit more of a detrimental impact or a little bit stretched stress for the overall economy. So we don't expect further ease on the fiscal side, largely a continuation to what we have seen, and a strong mandate gives a little bit more of comfort that you don't need to earn more on the populism side, which is what is getting reflected over the last fortnight's yield movements as such.
Before we wrap it up, the first announcement which came from the new government is that the PM Kisan scheme is going to be extended. Now, we may argue about whether it will be part of fiscal, whether it will be on balance sheet, off balance sheet, but look at it. I mean, the first announcement which comes that PM Kisan scheme is going to be extended. So obviously that is not, if that is not populism, what is populism?
Overall, the number what is involved in this is relatively small. So we have to go into the details of the budget to see what more they come up with. The first announcement which came from government, I think overall as a number or as a percentage of GDP is substantially smaller to move the needle too much towards populism. So, like I said earlier, I still believe that government may not need to further ease the fiscal strengths, and even if they were able to maintain the same pace what they have announced in the February, that largely should help. And bonds in itself are trading at a considerable spread over repo rates. Whatever has happened over last 3 weeks, be it a government change domestically or a strong mandate domestically or a slower GDP or what is happening on the global side, be it the backdrop of protectionism and trade war and the effect on commodity prices, all this bodes well for this spreads between repo rate and market yields to ease further. And hence, even if government maintains the same fiscal stance, it should be able to balance well both the fiscal as well as the growth aspect.
All right, Saurabh, appreciate your time. Thank you for joining us. Now,